Hey everybody, Mike here again. Hey, in my intro video to this series, I gave you kind of a 30,000 foot view, a high level overview of private family banking, and kind of talked about the basics of what it is. I mentioned it's a whole life insurance contract. I mentioned that there's a lot of benefits to doing it. Okay, but before we get into what those benefits are and how to take advantage of them, it's really important to understand what a private family bank is and how it works. Okay. In short, a private family bank is the use of whole life insurance policy to finance your own life. You're using your whole life insurance policy to take control of your own personal finances. Now, maybe you are borrowing money in order to have something, a car or a home. You have a mortgage or a car loan out, and you've got a payment associated with that, and part of that payment is interest. Well, a private family bank allows you to redirect that interest to yourself and pay you interest instead of paying the interest to somebody else. Maybe you're looking to purchase a car or a home. Instead of going through the process of financing that through a dealership or a bank, then you can finance that yourself with your own pool of money. And you don't have to go through a credit check. You don't have to go through an approval process. You borrow that money against your own cash value because it's yours, right? You have access to it. Now, it's important to remember one thing, and that's that this only works when a policy is properly structured, okay? And I'll talk about what properly structuring one of these policies means in a separate video. But it is important to remember that you have to properly structure these in order to take advantage of all the benefits, okay? So whether you lend your money to somebody, to yourself or to somebody else, your life insurance contract continues to grow tax-free. That's one of the benefits, right? You take out a loan that doesn't affect the value or the quantity of your cash value in your policy. That continues to grow tax-free, and then you pay back the loan to the insurance company. Okay. Now, there's a couple of things we need to understand before we can dig deeper, and maybe a couple of things that we need to agree on. Okay, first, we need to agree that a private family bank is not an investment. Okay, it is a financing and savings vehicle. Now, a financing and savings vehicle is not a product. It is a process. So we're embarking on a process. We're not purchasing a product. Okay. Now, in order to participate in financing and savings, a pool of money must be created. In our case, that pool of money is going to be the cash value inside of our whole life insurance contract. Okay. Now, the second thing we need to agree on is that a person finances everything that they do. Now, this is true whether you take out a loan or whether you pay cash. So let's say you take out a loan. Well, you're paying interest on that loan. That's obvious, right? So you're financing that way. Well, if you pay cash, you're also financing, because for a couple of reasons. You may hear somebody say, well, I don't like to have a car loan because I don't want to have a car payment. I don't want to have to make a car payment, so I'm going to pay cash for the cars that I buy. Two problems with that approach. One is that if you're going to pay cash for the car, you would need to save the money up, right? And then you liquidate that money in order to purchase the car. Well, let's say 10 years down the road, you're ready to purchase another car. If you haven't saved the money between your first purchase and your second purchase, then you don't have the cash in order to buy the car. So you're essentially making a car payment. You're just doing it differently. Okay. And you maybe say, well, at least I didn't pay interest. Well, that's true. But here's the second piece of it. You gave up interest that you could have earned on that money had you not liquidated it. Okay, so important things to understand about the difference between saving and borrowing and all of that. Now, in the case of taking out a loan, one of the biggest mistakes that people make is they say, well, I have a good interest rate, and they only look at the interest rate. But what people should be looking at in addition to that, and I'm not going to say that interest rates don't matter, but in addition to that, look at the volume of interest that you're paying. Okay. For example, if you have a mortgage, look at your mortgage payment, and let's take a look at, even if you have a 3% interest rate, which we've seen in the past couple of years. Let's say you have a 3% interest rate. Look at the volume of interest that you're paying. In other words, you'd be surprised probably to realize that maybe as much as 3%, as 50% of all of your payments is going to interest on a 3% loan. Okay, so that means 50 cents out of every dollar that you pay towards that house payment is going to somebody else in the form of interest. That's especially true in the earlier years of a mortgage loan. Okay, now, and here's the other thing. I would argue that you're not going to find 3% interest rates anytime soon anymore. So as those interest rates rise, that percentage of volume is also going to rise. Okay, now what if this interest could be recaptured? Okay, and then you start paying that interest to yourself rather than to somebody else. Well, if you could do that, then your ability to grow wealth would increase dramatically. Now, banks understand this, and this is why banks use something called bank-owned life insurance. Okay, and they use that to fuel their own banking system. A lot of banks, especially the big ones, have as much as 20% of their most strategic reserves in life insurance because they understand it's a safe, secure way to grow their money, and then they can use that money to lend to people and earn interest rates on both sides of the equation. Okay, banks understand it. The problem is banks can't, or normal people can't get bank-owned life insurance. But the way that we structure these, it acts as though it is a bank-owned life insurance policy for a person. Okay, so the question is, if your own bank using your own pool of money and lending to yourself or lending to someone else, how does the concept actually work in practice? In other words, what happens to my pool of money if I finance a car? Well, at a high level, this is how it works. Okay, your cash value is growing due to dividends paid out by the life insurance company. When you borrow money, you actually borrow from the life insurance company and you pay interest on the loan that you take out. Okay, you don't borrow it though from your cash value. Your cash value continues to grow as though nobody touched it. Well, how does that work? Well, your cash value is only used as collateral in the event that there's an unpaid balance on the loan when the policyholder passes away. Life insurance company, before they pay out the death benefit, they say there's a little bit of a balance here on this loan. We're going to pay that off, and then we'll issue the death benefit. Now, as a result, the cash value continues to grow as though the money never left the policy, okay, because it didn't leave the policy. The interest that gets paid back to the insurance company is part of what fuels the dividends that they pay to the policy holders. In other words, when you pay interest to the insurance company, you're actually paying yourself interest through the form of the dividend that they pay out at the end of the year. Okay. The key here again is to structure your policy properly in order to maximize the cash value that you have inside it. And we'll get it, we'll talk about what that looks like in another video. So let's end this video by discussing maybe when it's best or most appropriate to use a private family banking policy. Outside of the obvious life insurance piece, here are some of the ways that you can use a private family bank. Real estate investment, car or home financing, estate planning, wealth multiplication, charitable contributions, college savings, retirement planning, generational wealth creation, business financing. Okay, lots of different ways, and there's more that I could list off, but this is just a few ways that you can use a private family bank to fuel your own personal finance system. In essence, any time that you think you might be able to use capital, you can use one of these. And as we go through the series, we're going to take a look at how the concept actually works, and I'll give you examples of how private family banking has been used to get the most out of each one of these scenarios. So if you want to follow along, if you want to learn more, please like, subscribe to the channel, hit that bell so you get the notifications when we drop a new video. If you want to contact us, I'll put my email address and our website into the notes underneath. So you can reach out to us there as well to learn more. But we look forward to sharing this more with you in the future. And thanks for following along. Mike, I'll talk to you again in the next one.